In the cryptocurrency market today, as of early February, Bitcoin has experienced a sharp decline, dipping below $75,000 just days ago, only to see a modest rebound. This movement reflects broader pressures rippling through the entire sector. Ethereum and XRP have followed suit, with significant weekly losses underscoring a collective downturn. Many investors panic during such episodes, viewing them as isolated crypto-specific failures. They often attribute crashes solely to hype cycles or regulatory whispers. In truth, these events rarely occur in isolation. External macroeconomic forces frequently play the dominant role. People commonly overlook how intertwined cryptocurrencies have become with traditional financial systems. This leads to underestimating the impact of global events on digital assets. A key misconception is that Bitcoin's scarcity alone shields it from broader market corrections. Reality shows otherwise, as sentiment and liquidity dictate short-term trajectories. To grasp the current crash, consider the sequence of triggers unfolding in recent weeks. It began with shifts in U.S. monetary policy expectations. President Trump's nomination of Kevin Warsh as the next Federal Reserve Chair signaled a more hawkish stance. Markets anticipated fewer rate cuts, strengthening the dollar and pressuring risk assets. This nomination, announced in late January, prompted a re-evaluation of liquidity conditions. As borrowing costs remained elevated, investors rotated away from volatile holdings like Bitcoin. Geopolitical tensions amplified the unease. Conflicts between the U.S. and Iran contributed to a risk-off environment. Global uncertainty drove capital towards safer assets, such as gold or bonds. Within crypto, institutional behavior shifted markedly. Outflows from U.S.-listed Bitcoin exchange-traded funds reached nearly $1.5 billion in recent days. This withdrawal indicated waning confidence among larger players. Leverage within the market exacerbated the drop. Over $2.5 billion in positions were liquidated amid the volatility. Traders using borrowed funds faced forced sales, creating a cascade effect. Thin weekend liquidity further intensified the decline on February 1st. Bitcoin fell to its lowest point since April 2025, around $75,000. Ethereum, priced at about $2,310 today, saw a 21% weekly drop. Despite strong on-chain activity, it suffered from the same macro headwinds. XRP, at $1.61, declined 15.3% over 7 days. Positive regulatory news in Europe offered some counterbalance, but not enough to stem the tide. The total crypto market cap stands at $2.66 trillion, up 2.6% in the last day, but still reflecting recent losses. Bitcoin's dominance remains at 57.2%. This crash echoes patterns from late 2025, when tariffs on China and stablecoin issues triggered similar unwinding. Psychology plays a central part. Fear grips participants, leading to herd selling. Yet, contrarian observers note that such purges often reset the market for future growth. Common mistakes include over-leveraging positions. Traders amplify gains but invite ruin during reversals. Another error is reacting to short-term news without context. Geopolitical headlines spark fear, but their effects often fade. Ignoring diversification exposes portfolios to concentrated risk. Many chase recoveries too soon, buying into false bottoms. A reality check. Crashes reveal underlying fragilities. Bitcoin's energy consumption and scalability limits resurface as criticisms during downturns. Institutional adoption, while growing, brings new vulnerabilities tied to traditional finance. Watch for escalating liquidation volumes as a red flag. Rising funding rates on exchanges signal overextension. Monitor ETF flows for institutional sentiment. Persistent outflows suggest prolonged pressure. Track macroeconomic indicators, like Fed announcements or inflation data. Geopolitical escalations warrant caution. Avoid knee-jerk selling during volatility spikes. Instead, assess if core fundamentals, like network activity, remain robust. For Ethereum, rising institutional inflows could signal a pivot. In XRP's case, regulatory wins may bolster long-term resilience. Steer clear of high-leverage trades in uncertain times. Balance exposure across assets to mitigate sector-wide drops. In conclusion, the current crypto downturn stems from policy shifts, geopolitical strains, and market mechanics. Bitcoin's crash, while stark, fits historical cycles of correction. By understanding these dynamics, investors can navigate with greater poise. Markets evolve, but patience and analysis endure as the surest guides. If this explanation helped, subscribe for more clear breakdowns like this. Thanks for watching.